In today's video, we are going to talk about whole life insurance policies for kids and grandkids. We're specifically going to discuss some key items to be aware of if you're interested in a policy, perhaps for your child or your grandchild, and then some limits that insurance companies do enforce when it comes to policies specifically for minors. So what we'll begin with is how old one needs to be to start a life insurance policy, or how old your child or grandchild needs to be for you to start a policy on them. So typically the minimum age is 15 days old. At 15 days old, you can qualify for life insurance. We've got 0 to 15 years old here. No medical exam is required. So if you are 40 years old, you may know this already, if you already took out a life insurance policy. When you apply for life insurance, typically what do you have to do? Aside from signing the application, you have to have a medical exam in most cases where a nurse comes out, takes blood and urine, they ask you several medical questions. It usually takes anywhere from 20 to 25 minutes. From the ages of 0 to 15, that medical exam is not required. All minors receive a standard non-smoker rating. It's almost like a group rating. When I say group rating, as if you're taking out a life insurance policy through work where you did not have to go through a medical exam, that's referred to as a group health rating. The insurance company is looking at the group as a whole, and they're assessing just a blanket health rating. Now, this rating for minors is not bad at all, but it's not great. In my opinion, it is much more favorable to have a preferred or ultra preferred rating where we went through full underwriting with an insurance company. However, we cannot do that until we are age 16, 17 years old with some companies actually. But what you can do is start a policy for a minor, and then when they are of age, they can go through a full medical exam and actually upgrade the rating to a preferred or ultra preferred rating based on their health at that point in time. But that is some valuable additional information there. Amount of insurance. So this one's important. The amount of coverage, this is the total death benefit that's available for a child, is typically limited. This does depend on the insurance company, and it's going to be limited between 50 and 100% of whatever the parent has in force or is applying for. So for example, let's say you're a parent, age 40, and the total death benefit you have of all life insurance combined. This can be whole life insurance, this can be a term policy, it can even include coverage you have through work. Let's say the total death benefit is $1 million. Okay, so you've got $1 million in coverage. Let's assume you're taking out a policy with a company that allows a maximum death benefit for your child of 50% of whatever you have. That would be how much? Let's say your child is age 10, 50% of $1 million, $500K. Now, if there's two parents, what the insurance company will look at is the parent that has the most coverage. So it's not both combined, unfortunately. It's whichever parent has the most life insurance. If one parent has 1.5 million in this case, well, in that situation, we'd be able to qualify for $750,000. But that is important to be aware of. It's typically 50 to 100%. And again, that range will depend on the exact company that we're working with. Here we've got a note. The total death benefit may not exceed $1 million. You will see some insurance companies state this, and some will enforce it. However, exceptions can be made here. We've seen them made quite often. The most important thing, if we're taking out a policy that starts with an initial death benefit greater than $1 million for a minor, the insurance company is going to ask why. What is the need for this large death benefit? It could be a larger estate planning case. It could be a case where the parents have a lot of life insurance coverage and they're maxed out, so they're looking to take out larger policies on their kids. We've seen cases like that. We can exceed that, but if you're working with us or anyone, just be prepared that if you're taking out a larger policy, they may ask for some reasons why such a large death benefit is taken out on a minor. That's not uncommon there. Here's another note. All siblings should have equivalent coverage. So what that means is, take, for example, we've got 4 kids in a family, and they range from ages 2 through 15. You want to start a policy for your 15-year-old and you want to pay in $5 grand per year, and the initial death benefit, let's just say, is $200,000. So if you just wanted to start with them and then take policies out for your other 3 children later, the insurance company is definitely going to ask why. During the application process, they're going to ask, why are the other 3 children not applying for coverage? Or why are the parents or grandparents not applying for them and only taking a policy out in 1 child? And they do want a detailed explanation here. So typically what they're looking for is all siblings to have equal coverage. So they would want each of the 4 children here to have coverage of $200,000. Now, we've had success in the past where individuals have stated, I want to start policies for each of my children at age 15 or at age 16. It's a gift. When they hit this age, here's what I'm going to do. I plan on starting a policy that's all the same size. Sometimes that's worked, and sometimes it has not worked. It does depend on the company, the overall situation. That's not an automatic yes, no problem, because this is a rule they do look at to say, hey, we want equal coverage across the board here. Now, what I'll also say, I said equal coverage, equal funding will also do the trick, because from a cash value standpoint, if I take a 2-year-old and a 15-year-old, I do not need the same death benefit to attain the same MEC limit. Not to get all technical on you, my point is, if my goal is to maximize cash value, and let's say for each of the 4 children, the goal is to pay in $5,000 per year, well, the death benefits are going to range. Maybe the 15-year-old needs that $200,000 death benefit, but then the 2-year-old needs a $300,000 death benefit. Because the younger one is, the more life insurance they need for the same MEC limit. So I'm younger, so I need more death benefit to be able to pay in the same dollar amount. And this is really more information for the agent to be aware of. But at the same time, point is, if we have different death benefits but the same funding, that's never an issue. Or I should say, we've never had an issue with that. That's a case where the underwriter says, okay, we see exactly what you're trying to do. Thanks for the explanation. Approved. All good. So that's typically a good situation. And then one more exception here. Exception to higher limits if the parents have health issues. So this is a case I've seen a couple times just in my experience, where a parent wants to take out a policy, but they cannot. They're either declined or they receive an unfavorable rating because of health issues, but they've got a kid who's healthy. This is a situation where we have seen insurance companies and underwriters allow us to push the limits excessively higher than just the 1 million or 50 or 100%. We can't get the same death benefit that the parent could in most cases, but we can go much higher there because the underwriters do understand that this is a situation where the parents would, but they've got health issues. So what's the next best thing? Perhaps it's a policy on the child, but we do need to explain the reasons why we're taking the policy out. Is it just death benefit and or estate planning? Is it cash value buildup as well? They want to know all of the information there. So we'll provide the information. Policy owner and beneficiary information. We're mainly going to focus on the policy owner here. So this is a good one, especially for grandparents interested in taking policies out on their grandkids. So in most cases, the owner of a policy on a child is the parent. That's just most common. That's what we see all the time. It's not uncommon, though, for a grandparent to want to start a policy for their grandkids. And then on occasion, we see a trust set up or a trust that's already in place that can own the policies for the grandkids. But the most common is parents, and then sometimes we'll see grandparents. So let's focus on grandparents here, because here's where the question comes up. Grandparents owning a policy for their grandchild. Let's pretend that your grandma and grandpa, you are age 65. You've got a grandkid that is 10 years old. You want to take out a policy for them. You want to pay in $10,000 per year, however much it is. You, grandpa, have $1 million in current life insurance. Your grandchild has none right now. How much can they attain? Well, if we go back to that 50% rule, what would it be? $500,000. Could they attain that? The answer is no, they cannot, even though you own the policy. In a case like this, where a grandparent is owning the policy and paying for the policy, the insurance company is still going to look at the parent's total amount of life insurance, not the grandparents. So here's a case where grandma and grandpa have $1 million of life insurance. They want to take out a policy for their grandchild and fund it for cash value. But what's going to happen is the parents here have to have life insurance in place. So if grandma and grandpa are funding a policy with, say, $10K per year, and that requires a death benefit of $300,000, what that means is that the parents, one of the parents, have to have at least $600,000 in total death benefit. If they do not, it is going to be a no, where the parent has to attain more life insurance. It could be a term policy, but they've got to have that death benefit in place. If they have zero, those have been cases where the insurance company says, no, the parent has to have coverage first, otherwise we will not approve it. And there's no working around that. So that is a good item to be aware of in that particular case. If the grandparent is a legal guardian, that's a different situation. In a case like that, they're not going to look at the parent's total coverage. They'll look at the grandparent's total coverage because they are the legal guardian. Some examples. Let's have some fun here. We're going to look at 3 quick examples here. What we'll begin with is a college planning case where the funding is $5,000 per year through the age of 18. This is actually for a 3-year-old who's starting. Let's take a look at that and have some fun. So here we go. What we've got on the left, year 1, and how old are they? 3 years old. So we've got a policy with $5,000 per year going in. However, when we look to the left, there's our base premium at $500. So in the event that the parents want to reduce the funding, or they do not want to commit to $5,000 per year, they're committed to that base premium. With this particular company and product, the true minimum commitment, just with other riders and requirements, is $750. That's the total net amount. The base premium is $500, but there is a required PUA payment of $250 that makes the policy flexible. My point is, they're committed to $750, but here we're assuming they pay in $5,000 every year. By year 5, when their son is 7 years old, they've paid in $25,000, and they have $25,000. Now, going back to day 1, we see they paid in 5. The cash value is $4,250. What's the death benefit initially? $575,000. So if this is your son, how much life insurance do you or your spouse need to have in place in order to take this policy out for your son? 575 times 2. That's how much, and that's total. That can include whole life, term life, coverage you have through work. It can be coverage you're applying for, but that's the total amount you need to have. Unless you're applying with a company that allows 100% of your coverage, which would mean you need to have how much? A death benefit of $575. All right, fun stuff, right? Year 10, you've paid in a total of $50,000. There's your cash value. By the way, what these columns are to the right, we've got annual cash value growth. This shows how much the cash value is growing by each year net, and then the total gain on cash value. What you'll notice here is by year 5, we've got your cash value highlighted in yellow. At that point in time, your cash value is greater than your total payments. That's also where we'll see a gain on the policy. It's the first year we are not in the red. We funded up until age 18. Sometimes we look at funding through 18, but here we stopped at 18 only because this is usually when we're going to college or the child is now going to college. So at that point in time, we're not going to fund it. We're going to begin using it. And we've got just about $100,000 there. And that's built up in cash value along with a death benefit. And you've got access to it. If you don't need it, you can allow it to continue to grow. If you don't need it and you want to keep pumping money into it, you can keep doing that too and watch that cash value grow. But that's one quick example there. Let's take a look at another one. Grandparents' gift. So what we've got here, are the grandparents taking a policy out for their 10-year-old and funding it with $10,000 per year. So what we're going to start with actually is just a growth model. And then we'll look at a pretty cool concept. So what we've got here, $10,000 per year the grandparents are funding. Death benefit over here, $800,000, which means the parents need to have what? 800K to 1.6 million. And again, this will depend on the company. I'm not mentioning companies in this video because all companies have different rules here. But $800,000 in total death benefit. First year cash value, just about 87%. It's cash rich right out of the gates. When's your break-even point? Just about year 4, where you've paid in a total of $40,000 and your cash value is $39,951. By year 5, you are positive. By the 10th year, $100,000 has been paid into the policy. Again, the plan here was to give them a gift of $10,000 every year. Beginning year 11, they pay in nothing. Now they can continue to make payments. The parents can continue to make payments. Even the child or the grandchild in this case can continue to make payments. And they can even pay just the minimum premium. If they said, hey, I can't pay 10 grand, but I can pay less than $100 a month, that I'm interested in, well, that you could easily do here. But in this example, we're going to stop payments altogether after the 10th year. There's the cash value as it grows, but a pretty cool strategy we've seen among grandparents in gifting strategies like this is they'll take a policy out where they fund it for 10 years or a short period of time, and then they'll turn the dividends into cash. What that means is when you start a policy, typically the option for dividends is to have it purchase PUAs, which accelerates the cash value growth. Dividends go right into PUAs, just like you adding money into PUAs. However, you can elect to have them paid in cash. In my opinion, that is an okay idea. Turning the dividends into cash, the only thing to be aware of is when you receive that dividend payment every year, that is acting as a withdrawal. So eventually what's going to happen? You're going to hit your cost basis, which is your total payments since day 1. So if you are just receiving these dividends as cash payments, eventually you're going to get back more money than what was paid into the policy, and that will be taxable as ordinary income. Now there's ways you can work around that too, but in this particular case, what I ran instead of just turning the dividends into cash was first taking out withdrawals up to our cost basis, and then after that, taking out loans and not paying them back. And for simplicity, we just ran the illustration at $5,000 per year. Okay, so what we've got here through policy year 10, both models are identical, but what happened in year 11? $5,000 per year we're taking out of the policy, total funding by the 10th year, 100K, and then what starts to happen here? We see it decrease by $5,000 every year because we're taking $5,000. So what grandparents will do, they'll say, okay, when our grandkid turns 20, usually it's 21, but it can be any age, we want to turn on an option where they receive a check every single year. And it reminds them of us that we set this policy up for them. So here's the 5K per year coming out. And we just ran this indefinitely. The 5K is pretty conservative relative to the cash value buildup here. And maybe we scale the income up. Maybe we account for inflation and gradually increase it every year. But my point is, what do you notice about the cash value and death benefit? While you are taking that $5,000 per year out, still increasing. Cash value at least. The death benefit does, then it starts to come down. My point is, we're able to take that 5K per year. I did it up until age 85. We can keep going. It doesn't really matter here. But we're able to keep taking that while the cash value continues to build up. And if you really wanted to get creative, you could even continue to fund it. You could access additional cash value, perhaps when the child is 35 years old, they want to buy a home. In addition to the 5K per year coming out, they say, you know what? I need a $100,000 loan. Can I access it? The answer is yes. Maybe you'll see a family set up a trust, where in the trust, it stipulates exactly how and when those funds can be accessed. Maybe there's payback terms. You can go on and have a lot of fun with these policies. Anyway, so I don't continue to ramble. Let's look at the last case study here. Large policy to set kids up for success. And this one was based on a recent case study, or a recent individual that I worked with that started policies for his 2 sons. I made this one a 15-year-old daughter. 15 because up until what age do we not have to go through a medical exam? Age 15. Then we've got a 17-year-old son here. So 1, we wanted to make it a son and daughter. This way you could see some variety. And then 2, one with no medical exam and the other with a medical exam. So 15-year-old daughter, $24,000 per year or $2K per month. Exact same thing for the son. Here's what I want to hit on. Death benefit, $1.4 million. That exceeds $1 million. Death benefit over here, $1.2 million. So you've got 2 things that an underwriter is going to look at very, very quickly. They're going to say, okay, the total death benefit exceeds $1 million. That's typically where we say no. And then number 2, the death benefits for both siblings are different. Typically, we want them equal. So this case and these types of cases are frequently approved. Here's why. Number 1, the funding is consistent. The policy design is consistent when we look at the base premium and total funding. And then number 2, the parent has a lot of life insurance coverage in force. I've got to go back and look at the exact number, but if my memory serves me correctly, it's above $5 million. So it's a large death benefit. He's heavily funded the policies. Policies slightly over $1 million for a parent who's got $5 million plus in coverage. That's a case where they look at it and say, okay, that's not excessive at all. We will approve this. This one was quickly approved without any questioning there. But if he didn't have that, it would likely be a no. But as we look at these options, what do you notice? The initial cash value, very comparable. Both are very close to $22,000 right out of the gates. Let me actually hit in this death benefit a little bit more. You've got different death benefits here. We've got a 15-year-old female and a 17-year-old male. While the death benefits are different, the policy design is almost identical. And here's why. Here's our 15-year-old female. $1.4 million in total life insurance. Here's your base premium, $2,400. Okay. Bottom right-hand corner, MEC limit, $32,000 and change. Got it. 17-year-old male. Base premium, identical. Death benefit less, but MEC limit's just about the same. Different ages require different death benefits for the same MEC limit. Who had the higher death benefit when we looked at it? Do you recall that? It was the sister. The younger you are, the more life insurance you need for the same MEC limit. So just a technical detail that doesn't hurt to know. But anyway, equal from a cash value performance standpoint when we look at it. The daughter has slightly more cash value when we look at it long term, mainly because females live longer than males. So internal pricing is a little bit more favorable. For example, year 25, $600,000 paid, $1,030,000 compared to year 25 over here with the son, $1,020,000. 25 years in, $10,000 difference considering what the cash value is and what he's paid. Not a huge, huge difference there. In any event, I hope you enjoyed this video. If you did, please let us know. Hit the like button, subscribe for more. And if you have any questions, please leave them in the comments section below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.